You've probably seen the headlines: banks and corporations are piling into Bitcoin. Public companies have been quietly swapping their traditional assets for a massive Bitcoin treasure chest, and this has been called a monumental shift in institutional strategy. But just as Bitcoin's price smashes past $120,000, the story you're being told is already out of date. If you look closer, this frantic corporate buying seems to be hitting a wall. The pace is slowing, the momentum is stalling, and it's happening for reasons the mainstream headlines are completely missing. So, why are they suddenly pumping the brakes? Have they lost their nerve? Is the institutional dream of Bitcoin adoption already dying? The truth is far more complex and reveals a much bigger story. What we're witnessing isn't an end, but a radical evolution. We're going to break down the real reasons behind this institutional slowdown, and most importantly, what it means for your money. Because understanding this shift is the key to navigating the next phase of this financial revolution. To understand where we're going, you first have to grasp the sheer scale of what's already happened. The corporate move into Bitcoin wasn't a timid dip of the toe in the water, it was a cannonball. This wasn't about a few tech companies making a speculative bet. This was a calculated rotation of capital on a level the financial world has never seen with a new asset. It all started as a trickle, led by the titan of the movement, Michael Saylor of MicroStrategy. Back then, it was a radical idea: take the cash on a company's balance sheet, an asset meant to be stable and safe, and convert it into a volatile digital currency. The rationale was simple, yet profound. They saw central banks printing fiat currency relentlessly, the slow burn of inflation, and pathetic returns on traditional safe haven assets. They saw the ice cube melting, and they needed a freezer. Bitcoin, with its mathematically enforced scarcity of only 21 million coins, presented itself as the ultimate solution. It wasn't just another asset, it was an escape hatch from a monetary system they believed was fundamentally broken. It was a hedge against inflation, a new store of value, and a diversification tool completely outside the traditional financial system. And so the trickle became a flood. Following MicroStrategy's lead, a wave of public companies began adding Bitcoin to their treasuries. We saw an incredible diversity of industries joining in. Bitcoin miners like Marathon Digital and Riot Platforms naturally began holding what they produced. But then came the unexpected players. We saw companies like Trump Media and Technology Group, and even the video game retailer GameStop making allocations. In Japan, the public company MetaPlanet made headlines by pivoting its entire treasury strategy to Bitcoin. As of late 2025, the numbers from institutional holdings are staggering. Publicly traded companies, private firms, and ETFs now collectively hold over 3.7 million BTC. Public companies alone hold nearly 1 million Bitcoin. MicroStrategy, now rebranded as Strategy Inc., leads the charge, holding over 640,000 BTC, worth well over $70 billion. Their holdings represent over 3% of the entire global circulating supply. This corporate buying created a powerful feedback loop. As more companies bought Bitcoin, the price rose. As the price rose, their stock prices soared, often far outpacing Bitcoin's own gains. This allowed them to raise even more capital by issuing new shares or debt, which they then used to buy, you guessed it, more Bitcoin. It was dubbed the infinite money glitch, a seemingly unstoppable engine for accumulation that drew more and more players into the game. It seemed like nothing could stop this corporate invasion until suddenly it started to slow down. Just as the narrative of the unstoppable corporate Bitcoin boom was solidifying, a new, more complicated picture began to emerge in 2025. The headlines of massive, multi-billion-dollar purchases started to become less frequent. Michael Saylor's weekly announcements, while still happening, were for smaller amounts. On the surface, it looked like the corporate appetite was waning. If you were to only read the surface-level analysis, you might conclude that the institutional experiment was failing. And there are three big reasons that seem to support this view. First, there's the problem of valuation sickness. For a long time, buying stock in a company like MicroStrategy was seen as a premium way to get Bitcoin exposure. Investors were willing to pay more for the company than the value of the Bitcoin it held. However, in 2025, that premium began to shrink. The stock performance of some of these Bitcoin treasury companies started to lag behind Bitcoin's own price gains. For example, while Bitcoin's price surged, MicroStrategy's stock, MSTR, underperformed, suggesting that investors were becoming less willing to pay a premium for this type of exposure, especially now that they had other options, like Bitcoin ETFs. Second, the capital wasn't infinite after all. The engine of this corporate accumulation was fueled by capital raises, primarily through issuing new stock and taking on debt. But this strategy has a major consequence: shareholder dilution. Every time a company issues new shares to buy Bitcoin, it dilutes the ownership stake of existing shareholders. By late 2025, it was reported that MicroStrategy had funded a staggering 94% of its recent Bitcoin purchases through stock dilution, having issued millions of new shares. You can't keep slicing the same pie into smaller pieces forever before investors get spooked. This financial engineering, which had seemed so brilliant on the way up, was now acting as a natural break. Third, and perhaps most importantly, is the persistent shadow of regulation. While the regulatory environment has dramatically improved with the landmark approval of spot Bitcoin ETFs and a more welcoming stance from regulators, uncertainty remains. The financial world operates on certainty. For a corporate treasurer to allocate billions, they need a clear understanding of the rules. While Europe has moved forward with its MyCar framework and Hong Kong is creating its own rules, the global regulatory landscape is still a patchwork. This ongoing conversation, even when positive, naturally tempers the pace of adoption. So, when you combine these three factors, shrinking stock premiums, the limits of dilution, and regulatory uncertainty, it's easy to see why someone might think the party is over. But that conclusion is fundamentally wrong, because what is happening is not a retreat, it's an evolution. So, is the dream of institutional Bitcoin adoption dead? Not even close. What we're seeing isn't an exit, it's a sophisticated evolution. If you're only looking at the headlines about corporate buying slowing down, you're missing the real story. The game has changed. First, the initial land grab is over, and now the strategic game has begun. The first phase of institutional adoption was a frantic digital gold rush. It was driven by an urgency to acquire a meaningful position in the world's scarcest asset before anyone else. Companies like MicroStrategy were the pioneers, planting their flag and claiming vast territory. But that phase is maturing. The question is no longer how much Bitcoin can we buy and how fast. Instead, the question has become how do we strategically integrate this asset into the global financial system? This leads to the second crucial point. The smart money is changing its tactics. The slowdown in direct treasury purchases doesn't mean institutional interest is fading. It means their methods are becoming more diverse and sophisticated. The approval and explosive growth of spot Bitcoin ETFs in 2024 and 2025 was the single biggest game changer. These regulated vehicles provided a clean, simple, and familiar bridge for institutional capital to flow into Bitcoin. We've seen this with the staggering inflows into products like BlackRock's iShares Bitcoin Trust, IBIT, which amassed tens of billions in assets in a remarkably short time. This is where the institutional money is flowing now. It's less about individual corporate announcements and more about the quiet, consistent daily inflows into these massive ETF products, with billions pouring in weekly during periods of high demand. So while direct corporate buying might be moderating, the overall institutional acquisition of Bitcoin has actually accelerated dramatically through these new channels. The third, and perhaps most profound revelation, is that the market itself is growing up. The very presence of this institutional capital is transforming Bitcoin from a volatile, speculative asset into something more mature. In the past, Bitcoin was notorious for its wild price swings, but data from 2025 shows a remarkable shift. The average daily volatility of Bitcoin has decreased significantly since the launch of the ETFs. One report noted volatility had been cut by more than half. This is the strong hands effect in action. Large institutions are less likely to panic sell during market dips. This creates a more stable foundation for the price, reducing the extreme drawdowns we saw in previous market cycles. For instance, post-ETF approval, while major drawdowns still occur, they have been less severe than the historical highs of 77%. This reduced volatility is a feature, not a bug. It makes Bitcoin a far more attractive asset for conservative institutions, underpinning bullish price predictions from major banks, with some analysts forecasting targets of $165,000 or even $200,000. The corporate buying frenzy didn't stop. It evolved. It moved from the front page to the plumbing of the financial system. If the first wave of corporate pioneers was the chaotic gold rush, the current slowdown is simply the quiet moment between waves. And the next wave building on the horizon is an order of magnitude larger. We are talking about the big banks and major financial institutions. For years, figures like JPMorgan CEO Jamie Dimon were vocal critics. Yet today, JP JPMorgan is not only allowing clients to invest in Bitcoin, but has also set a price target of $165,000 for Bitcoin in 2025. They are not alone. Giants like Citi, HSBC, and State Street are all actively expanding their blockchain related services, driven by overwhelming customer demand. This shift was unlocked by crucial regulatory changes, specifically the rescinding of rules like Staff Accounting Bulletin 121, SAB 121 in the US, which had previously made it prohibitively difficult for banks to custody crypto assets for their clients. With these barriers falling, the floodgates for bank participation are swinging open. Beyond the banks, we have the wealth management industry. The success of Bitcoin ETFs has given asset managers and family offices a regulated way to offer this exposure to their clients. Fidelity announced back in 2022 that it would allow Bitcoin in some 401k plans, and while widespread integration is still developing, the move signals a monumental shift. It means Bitcoin is moving from a niche investment to a potential component of long-term retirement planning. This could unlock trillions in institutional capital in the coming years, though estimates vary and remain speculative. Finally, there is the ultimate prize: sovereign wealth funds and central banks. For years, the idea of a country holding Bitcoin as a reserve asset seemed like a fantasy, but the conversation is now happening in corridors of power worldwide. As Bitcoin's market matures, its properties as a hedge against the debasement of fiat currencies become harder to ignore. It is no longer a question of if a major nation will add Bitcoin to its reserves, but when and who will be first. This next wave of adoption will look very different. These institutions move more slowly and deliberately, but they also command vastly more capital. Their entry won't be marked by flashy press releases. It will be a quiet, systematic, and relentless absorption of Bitcoin into the very foundation of our global financial system. The current slowdown is just the sound of these giants taking a deep breath before they plunge in. So, the institutional move into Bitcoin isn't slowing down, it's evolving. But what does this mean for you, the individual investor? Here are 3 key takeaways for your personal playbook. First, and most importantly, do not mistake a pause for a reversal. The headlines suggesting a slowdown are a lagging indicator. This period of seeming quiet is exactly the kind of environment where weak hands get shaken out. Retail investors might see a lack of explosive announcements and assume the momentum is gone. Meanwhile, the smart money, the institutions, are doing the exact opposite. They are using this period to accumulate quietly through ETFs. The lesson is clear. The underlying trend of institutional adoption is stronger than ever. It's just become less visible. Second, watch the flows, not just the price. In the old retail-driven crypto market, the daily price chart was everything. But in this new institutional era, the real story is in the flow of funds. The most important data points are now the net inflows and outflows of the major spot Bitcoin ETFs. These figures, released daily, tell you exactly what institutional players are doing. When you see billions of dollars consistently flowing into these ETFs, it's a powerful signal that the institutional thesis is intact, regardless of short-term price volatility. Third, and finally, understand the new risk profile of Bitcoin. For over a decade, Bitcoin was correctly seen as a high-risk, high-reward speculative asset. Its defining characteristic was extreme volatility. But as we've discussed, that is fundamentally changing. The influx of institutional capital is acting as a massive stabilizing force. Bitcoin's volatility, while still higher than traditional assets, has been structurally reduced. This means it is transitioning from a purely speculative gamble to a legitimate component of a diversified portfolio. The perceived risk of it going to zero has dramatically diminished now that the largest financial institutions in the world are building products around it. The risk profile has changed, and your investment strategy should reflect that new reality. So, the narrative that banks and corporations are getting cold feet on Bitcoin is a dangerous misreading of the situation. The corporate move into Bitcoin isn't stopping, it's evolving. The initial chaotic land grab is over. The era of strategic positioning has begun. The slowdown you see in headlines isn't a sign of fear. It's the quiet, powerful hum of a much larger engine being built beneath the surface of the financial world. An engine fueled by the steady, relentless inflows from the world's largest financial institutions. The story has shifted from individual corporate treasuries to massive regulated ETFs. It has shifted from frantic buying to systematic accumulation, and it has shifted from a high risk gamble to an increasingly mature asset being woven into the fabric of the global financial system. Understanding this shift is the single most important key to navigating the next phase of this financial revolution. The question is no longer if institutions will adopt Bitcoin, but how. And now you know what to look for. If you want to stay ahead of these trends and get my weekly insights on where the institutional money is moving next, make sure you join the free newsletter. The link is right at the top of the description below. It's the single best way to stay informed as this new chapter unfolds. Click that link, and I'll see you there. And of course, if you found this deep dive valuable, do me a favor and hit that subscribe button and turn on notifications so you don't miss the next one. Thanks for watching.